The stock market has been a little bit crazy. After breaking record highs in July, it's been a rough August with stocks getting slammed and the Nasdaq entering correction territory. And after reading some of the comments on my recent videos of people panicking and freaking out with the stock market going down, I decided to make this video talking about how you can profit when you see craziness, when you see a stock market crash. That way you can build wealth when the majority of people are losing. Now, if you've been subscribed to my channel, you know that I love financial history. So let's start with a little bit of history, because while history doesn't repeat itself, it does rhyme. Let's assume you invested in the Dow Jones in February 2020 when it was breaking record highs right before the pandemic hit, and then the pandemic hit. And we saw the fastest sell-off of stocks in history. But even if you bought right at the peak, by November of the same year, you would have been profitable again. But of course, the pandemic was a weird time, so let's go a little bit further back. Let's assume you started investing in October 2007, the peak before the 2008 Great Recession, and then of course, markets collapsed. But if you held on to your stocks for 5 years, you'd be seeing record highs again. And if you're still not seeing a pattern yet, let's look at one more. If you invested in the Nasdaq during the 2000 dot-com bubble at the peak, you would have experienced, again, a once-in-a-lifetime market crash. But if you held on, by 2014, prices were breaking record highs again. Now, I get it. You don't want to wait 14 years to make money. That's not my goal with this video. My goal is to talk about how you can find the opportunity. And the way we're going to do this is by talking about three things. Number one is I'm going to highlight what's going on in the markets today, causing all the recent craziness that we've been seeing. Number two is I'm going to talk about how not to lose when you see craziness in the markets, when you see a market crash. And number three is how do you win big and how do you find the opportunities? Make sure you stick with me until the end, because you're going to want to understand how all this plays a part in together. So let me start by talking about what's happening today in the markets. But first, thank you everybody for the well wishes for my travel back from Manhattan to Detroit. And secondly, a quick reminder that I'm hosting my biggest investing workshop of the year on August 14th and 15th. This year, I'm going to be going over, number one, how our money has changed, not just over the last 5 decades, but also over the last 5 years. But secondly, I'm going to be going over how our money has changed, how investment opportunity has changed, how you can find new economic opportunities today when you see the craziness in the economy, when you see the craziness in the markets, when we still have the high inflation and the high interest rates. How do you find wealth building opportunities? It's going to be a lot of fun. But if you want to join, you have to register, because we have a limited number of seats available. So if you'd like to join, it's completely free. It's virtual. I have a couple different times. You can join me on August 14th or 15th, and I got the link for you down in the description below. In the last week, there have been two things that happened that really triggered a lot of craziness in the stock market. The first thing is the data. The first piece of data that moved the market was we got a new manufacturing report, which said that in the United States, manufacturing had shrunk for 4 straight months, which had a lot of people worried about a potential economic slowdown. That was the first part. The second piece of big economic data was we got a bad jobs report, which said the unemployment jumped up to 4.3%, which meant that number one, employers hired less people than expected. Number two, employers laid off more people than expected. And number three, wage growth slowed down faster than expected. So all these things together created this bad amount of economic data, which then triggered part two, which is what I call the media effect. When this bad economic news came out, the stock market immediately went lower, and then every traditional financial news company used it as an opportunity to make some money by getting some clicks by showing you these stories, talking about how everyone is worried about a recession coming in the economy. Now look, I'm in the financial media business. Briefs Media is a financial media company. I understand how this industry works. And to be fair, there are some real red flags in the economy. There was some bad data in the economy. The stock market did go lower. But what I want you to do is understand how this industry works. That way you don't get into this emotional panic and this emotional financial driven state where now you start making decisions based off of what the headlines are telling you. That's not how you build wealth. Emotions are the enemy of profits. This is why you've heard me be so adamant about building market briefs, because now all the financial news is in one newsletter, and we don't have to have those crazy headlines or the crazy stories, because when you open up the email, all the financial news is in one email. So we don't need that sensationalism or the craziness to get people to read our financial news, which is why I've been working so hard to build this brand. But beyond that, what do you think happens when somebody who doesn't have a lot of financial education or doesn't understand the psychology of investing starts to see bad headlines about the stock market or sees bad headlines about the economy? Well, they sell. And that's exactly what we saw happen. Now look, my goal for you is to be able to understand the news and use the news and not be manipulated by the news. That's where your financial education comes in, and that's where your psychology comes in, which now brings me to number 2. How do you not lose when you see craziness in the markets? Because the reality is we really haven't seen anything that crazy yet. I mean, yeah, we saw a little bit of a sell-off, but it's really not that big of a deal if you look at the grand scheme of how much the markets have risen over the last few years. And the way you do this is by understanding 3 things. Number 1 is how do you be prepared? Number 2, how do you buy the right assets in the first place? And number 3 is how do you not get emotional? And if we start with how do you be prepared, the first thing you got to understand is what is investing? Investing is not a separate bank account that holds your emergency money. Investing is money that you don't need, that you put aside into these investments, and you think of this money as gone, that now you're working to grow this money. The reason why so many people end up getting emotional is because they look at their stock account as a separate savings account, as a separate bank account to keep your spending money. That's not what your stock market account is. Your stock market account is your investment account, it's your wealth building account, and that's separate. This is a long-term account where we're talking about years or decades worth of growth. You are going to see booms and you're going to see crashes. Stock market crashes are a part of our system. We have seen a recession pretty much every decade for the last century. The longest period that the United States economy has gone without a recession was after the 2008 great financial crisis and the 2020 pandemic. Okay, recessions are a part of our system. Market crashes are a part of our system. You have to understand that these things happen. And so now when you understand that and you invest your money, you got to know that there will be times where markets go up and there are times where markets go down. This is a fact. It has happened for the last century and it will continue to happen. So now when you understand that, you will put different amounts of money in the markets, hopefully that we don't invest money that you need tomorrow. You don't want to invest money that you aren't willing to lose, because you got to understand that this money that you're investing is money that you're parting ways with for years, if not decades. That way your money actually has time to grow, which brings me to part 2, is how do you buy the right assets? If you notice in the beginning of this video, I talked about buying shares of the Dow Jones and buying shares of the NASDAQ. I didn't talk about investing in individual companies, because the reality is many companies went bankrupt during the 2000 dot-com bubble bursting. Many companies went bankrupt during the 2008 great financial recession. Many companies went bankrupt during the 2020 pandemic. And if you invested your money into a company that went bankrupt, all of your money was gone. Your money went to zero. So now, if you're talking about buying the right asset, what that means is you got to know your investment strategy. For some of you, that's going to mean investing in individual companies, which means you're going to have to do the financial education to understand what you're investing in, keeping up with the financial statements and keeping up with the company. But that's the minority of people. What I like to say is 98% of people in America should not be investing in individual companies. So what do you do then? Well, the alternative is you can invest in a fund. There are funds that give you exposure to the Dow Jones. There are funds that allow you to invest in the S&P 500, the largest 500 companies in the stock market. There are funds that give you exposure to the NASDAQ. There are funds that give you exposure to tech companies. There are funds that give you exposure to AI companies. There are funds that give you exposure to REITs. There are funds that give you exposure to dividend-paying companies. There are funds that give you exposure to Chinese companies, Indian companies, emerging market companies. And so now, instead of investing in individual companies, what you can consider is investing in a fund, because now if you invest in something like the S&P 500 and one of the companies in the S&P 500 goes bankrupt, your whole fund doesn't go bankrupt. Because when Sears goes bankrupt and they're kicked out of the S&P 500, they're replaced by another company, and it's automatic. So now, when you're investing in these broader funds, especially if you're investing in the broader stock market, because there's also funds that give you exposure to the total stock market, well now, if one of the companies in your funds go bankrupt, you're still okay, because there are other companies in that fund to balance out the losers. So you lower your potential returns, but you also lower your risk. And if you're not willing to keep up with the company, if you're not willing to do that work, then you don't want to be investing in individual companies, because now you're taking on all the risk and you're just hoping for the upside. That's where the gambling comes in. If you don't want to do that, you can just invest in the stock market, because what we've seen happen over the last century is markets go up, markets go down. The people that don't know what they're doing lose when markets are going down, and then they start buying when markets are booming. That's not the game that you want to play. Obviously, if you can buy low and sell high, that's the best of both worlds, but most people don't know how to do that. And instead, if you just invest into the markets, well now, you're just investing in the stock market. When the stock market grows, you grow. When the stock market goes down, you go down, but you can use that as an opportunity to buy even more. And you don't have to worry about one company going bankrupt because you're investing in the broader market. So you can consider now investing in funds. And number 3 is don't get emotional. But I want to remind you before I talk about this that I am not a financial advisor. I'm just a random guy on YouTube. Everything that I talk about is not something I learned in a textbook. It's things that I learned from my own experiences and my own mistakes. I can't recommend what I do to anybody else, and I can't recommend what you do. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. So now when we talk about don't get emotional, I said earlier, emotions are the enemy of profits. And the media is in the business of selling emotion. They're going to sell you that the world is ending, the market's collapsing, you got to get out while you still can. Or they're going to sell you that everything is great, everything is sunshine and rainbows, people are making so much money. Because those are the things that drive clicks. If they drive clicks, they drive ad revenue, and that's how these traditional media companies make money. So you gotta be able to separate through the noise and separate through the emotion, and also understand that recessions and market crashes create more millionaires than any other time. Why? Because they create buying opportunities. The stock market is the only place where when things go on sale, people stop buying. That's the place when things go on sale, meaning stocks go down, people run away. But when Macy's goes on sale, people line up. When you see a sale at Apple, if they offer sales, people would line up out the door. But when the stock market's having a sale, people run away and they sell and they panic and they say everything is a scam. This is where you got to understand the psychology of investing if you want to be able to build wealth, which now brings me to number 3, which is how do you win big? The reason why the majority of people lose money in the stock market is because they don't understand how to poop, but you're going to know how to poop correctly. That way you can build wealth when bad things happen in the stock market. What is poop when it comes to investing? Poop stands for panic, leads to overselling, leads to opportunity, leads to profits. When you understand poop, you're gonna find the opportunity. That way you can build wealth while the majority of people are losing. Look, I get it. I know poop is a silly acronym, but the whole reason behind this is so it's easy for you to remember, because the reality is when craziness happens in the markets, when craziness happens in the economy, people lose their sense of logic. But it's easy to remember poop. So hopefully next time you see something crazy happen, you can remember this poop, because the reality is when markets go down, you don't actually lose money unless you sell. I mean, the only kind of exception to that is if your company goes bankrupt. But if you're investing in a strong asset and it's down 50%, you don't actually lose any money unless you sell. And this is where you got to understand how poop works, because anytime you see something bad happen in the markets, you see panic. Why does panic happen? Because you get that bad economic data, and then you get the media effect, because everybody's now talking about how bad things are, and this creates a negative spiral because you can buy and sell stocks within an instant. And so now when people are buying and selling and selling and selling, people start to freak out, because now this pushes the markets even lower, which leads to overselling, because now people want to get out while they still can, because they're freaking out. They don't understand what's going on, which then creates opportunity, because then good and strong assets go on sale. They're cheaper to buy, and that creates opportunity for the financially savvy, because now you can go out and buy some great investments at a great price, which creates the opportunity for profit. But in order for you to profit, you have to have the long-term mindset and understand that investing is a long-term game. It's crazy to me when people say, oh my God, I invested some money 2 months ago and now my portfolio is down 10%. It's only been 2 months. You want to invest for the next 20 years. Who cares what happens in the short term? We know that market crashes happen. You want to use this as an opportunity to buy even more. Now, before you go out and just dump your money into markets, you got to know your strategy. This is the financial education. This is what I talk about in a lot of my videos. We talk about this in many different places, but you got to know your strategy. If your strategy is dollar cost averaging, every week you're putting money into the markets, you're buying the S&P 500. Every Wednesday you buy the S&P 500. Then what do when the markets go down? You keep buying the S&P 500. You don't change the strategy. The mistake that so many people make is they invest into their 401k. Markets go down, you stop investing in your 401k. You stop investing when things are on sale. See, that's not what you want to be doing. When things are on sale, the only change you want to make is potentially increasing how much money you invest. So now maybe you invest a little bit more aggressively. This is where you got to understand. Remember, poop. It creates opportunity, but you only capitalize on the opportunity for actually buying. When markets were crashing in 2020, what did people do? They sold and they stopped buying. What happened in 2008? People sold and they stopped buying. What happened in 2000? People sold and they stopped buying. And trust me, I know this firsthand, because when the 2008 crash happened, that's when I started investing in real estate. I didn't have a lot of money, but that's when I got started in my investing journey. Everybody told me that I had lost my mind. They told me that real estate built bankruptcies, it didn't build wealth. But to me, I saw it as an opportunity. Now, I wasn't that smart. I just kind of happened to get involved with investing at that time when real estate was very cheap. But I saw the sentiment then. The next major crash was 2020. This was when I was on YouTube. I was talking publicly about how I was buying stocks on the way down. I didn't know what was going to happen. Nobody knew what was going to happen in the future. It was a crazy time, but I was getting flooded with comments of people saying the same thing. Jaspreet, are you out of your mind? Markets are collapsing. Why would you want to buy now? And then we saw what happened. So we know the markets will go down. We know that we're going to see volatility in the markets. You want to use it as an opportunity, but in order for you to use it as an opportunity, you got to be able to cut through the emotion and you got to be able to find the opportunity. Now, what do you invest in? Well, this depends on now your financial education. This depends on your financial trends. This depends on what you see as the opportunity. That is a whole different section. What we're talking about now is the financial psychology side of how do you build wealth. The next part that goes a little bit deeper is the financial education and the financial trend side of understanding what industries you want to invest in. How are you actually going to invest? Are you investing in funds or individual companies? That's now a little bit deeper of how do you get involved in finding the right investments. Those are the things I'm going to be talking about on my Investor Summit on August 14th and 15th. But this is where now you got to start investing in financial education. That way you can find the best opportunity for you. You don't got to be perfect, but you just got to get started. I made this example a little while ago. It's just like getting in shape. You can say, I want to get in shape, and then you can start looking at all these diets. Do I do keto? Do I do carnivore? Do I do vegan? Do I do this or that, whatever? And then you can look into all the different exercises. Do I do HIIT? Do I do the low intensity stuff? Do I do yoga? Do I do Pilates? Do I do this? Look, at the end of the day, just get started. Get rid of the donuts, the Twinkies, and the ho-hos and walk on a treadmill. Once you do that, now you can say, maybe I add in some weightlifting. Maybe I change my diet a little bit more. You just got to get started, and then you can work to refine. It's the same with money. Just get started, and then you can work to refine. You got to learn to walk before you can run. And you got to run before you can sprint. That's the way the game works. Sure, you got a 600% increase in incomes over the last 50 years, but the prices of things that you need have gone up significantly faster than that. Back in 1971, the median household income was based off of one person's income. In 2023, most households were a 2-income household. So you double the number of people working, but most people still aren't able to keep up with the price growth of things.